Is this the start of an imminent recession following the end of the most recent economic expansion? And so, if you look at what the stock market has to say, it certainly seems like it. You see Target stock down over 25% today following a brutal first quarter 2022 earnings update. Similarly, Walmart down 7% following a 10% plus decline following once again a weak first quarter results. You also see Costco falling in sympathy, which is a little surprising because you see that Costco, just earlier this month was posting very strong growth figures, talking about high single digits, low teens growth when you exclude the impact from gas sales. I mean, Costco is an unrivaled company, incrementally taking share each year, and so here it is. It's falling in sympathy. Why is Costco even falling in sympathy? Well, part of the reason why Costco is falling is because the valuation got so rich. It was previously trading at 40 to effectively 50 times forward earnings multiples just a few weeks ago. Whereas if you look at where it's traded over the last 10 years, that's the highest it's been in the last 10 years. And so you could see, wow, there could be a lot of downside pressure if it were to re-rate to where it's been historically. And I think this is, the investment environment that a lot of investors need to get used to, which is they've looked at the last few years and said, hey, investing is easy. This is awesome. Valuation expansion is great. But the challenge is when you have valuation expansion, you oftentimes have valuation contraction, and valuation really does matter. And so looking at the recent period, you're seeing a period where growth stocks are getting hit, tech stocks are getting hit, consumer staples, everyone is facing that same valuation contraction, that you're looking at here with companies like Costco, Target, Walmart, and we'll talk about, the very aspects of what's going on with Target. Why is the stock down 25%? Today, what's actually driving this result? What's changing that sentiment that's pushing that valuation, contracting that valuation? Now, I've talked regularly on this channel about how long-term valuation actually doesn't really contribute much to investors' returns. So you have to focus on the fundamentals. Over a 50-year time frame, valuations really don't contribute close to anything. And so what's really the main driver is that fundamental sales and earnings. And that's the reason why this channel is called Unrivaled. I want to find those companies that have that right to win over time. And I call out, I'm looking for them on my own personal investment journey. I call them out to the Unrivaled Investing subscribers. And so looking, at a company like Costco, it's done really well. And a lot of people know it. But the challenge, once again, is that valuation got so frothy. And so if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no hype, mission focused channel, so leave the hype at the door. And so in this video, we're going to talk about how I'm personally handling, this sort of risk off environment. What is, if we're entering a recession, what am I to do? Do I think we're entering a recession? How do I think about that? I'll talk about that towards the end of the video. First, I'm going to talk about what's sort of the signal that the stock market's sending, and why is Target stock, another major consumer staple business, is down, getting hammered hard now. So now Walmart, I just did a video on that saying, hey, there's a big signal here investors should be aware of. And that was sort of calling out about the trade-off that consumers are facing between effectively food inflation and buying everything else. Now you're starting to see it with other players as well. This is an important bellwether for how the rest of the economy is going to play out, because consumers are about 70% of US GDP. So this could have huge repercussions. So let's dive right in. If this is your first time tuning in, please make a point of hitting that thumbs up and hit that subscribe button. And so looking at, so Costco, we already knew the valuation was frothy. Looking at Target sinking 25% is CNBC calling out saying, yeah, it's high cost, inventory woes hits profits. Yes, that is correct, but there's a little more nuance, to go into, where management talked about a rapid slowdown in the year-over-year sales trend at the beginning of March. So whenever you start talking about, this was a recent period and we're starting to see changes, that always gets Wall Street nervous, saying, hey, could this be a change in the weather? Could this be a change in, where we go from here? Now they were saying, yeah, but it was because we were annualizing the impact of last year's stimulus payments. Oh, okay. So that's not something to worry about. Like, yeah, you had this huge surge last year. You're not getting the same benefit this year. Okay, that makes sense. We didn't anticipate the magnitude of that shift. They didn't expect it would be as big of a shift as it was last year. They were carrying too much inventory, particularly in kitchen appliances, TVs, and outdoor furnitures. That said, overall, they're still seeing healthy spending by their guests. So this does not suggest that this is recession. This is suggesting, yeah, the consumer is healthy. It's just changing spending habits. So you look at things like apparel, home hardlines. Those things all saw declines. Apparel saw effectively was remained flat year over year, a slight decline. That said, last year it grew more than 60%. You look at home goods, that also declined, but sales once again are more than 40% higher than the first quarter of 2019. So once again, you should understand the broader context here, which is that the consumer is still doing really well relative to where it was back in 2019. So there's still dramatic expansion. It's just, whoa, you had this dramatic stimulus and now you're offsetting it. So it's not like Target is saying, hey, this is a recession. They're saying actually the consumer is quite strong. But there are some things to be cautious about, because you might say, well, wait a second. If Target's saying results are so good, why is the stock getting hammered? Why is Walmart getting hammered? Why is Costco getting hammered? Why is the broader market seeing this sort of risk off? I think it's this very dynamic that we're about to talk about, which is that, okay, look at their results. Results, once again, strong growth, 3% growth on top of 23% growth last year. Comparable store sales reflect strong traffic growth, so people are going to the stores. They're even looking at strong digital sales. Last year grew 50%, grew again 3% this year. But the challenge, and this is the reason why a lot of businesses are coming under pressure right now, is because it all ties back to what does the company earn and what's the valuation. And so looking at their operating margins of 5.3%, that was well below their expectations. Long term, they want to be over 8%. So you're looking at, 40% haircut to where they wanted to be, driven primarily by gross margin pressure. This is very interesting. And so one other, you're looking at gross margin pressure. You're looking at operating cost pressure. They talk about how the first quarter freight transportation costs came in hundreds of millions of dollars higher than our already elevated expectations. For the full year, they're now expecting $1 billion of incremental freight costs. This is $1 billion even compared to their expectations only 3 months ago. So this is a rapidly increasing cost environment. That's really important to think about, as you consider, well, what's going to happen to what's the general money supply, what's going to happen to valuations as the Federal Reserve is going to have to respond to this. So you look at how this translates into their business model. Yeah, sales were up. That doesn't look like a recession to me. 4% growth. You see, wait a second, but their cost of sales increased by 10%. So that means their gross margins are going down significantly. Oh, and their costs of effectively running their stores also grew faster than sales. So this translates, well, yeah, hey, good times, 4% growth in top line. They saw 40% decline in operating profitability. This is actually a very, very big deal for investors to consider. Let's sort of understand the repercussions here. So they further went on saying, as we face multiple cost pressures, our team is working tirelessly to maintain prices wherever possible. While it's always the last lever we pull, external conditions led us to raise prices across a broad set of items in multiple categories. Overall costs have been rising much faster than retail prices, resulting in year-over-year declines in our gross margin rates. Okay, so what's this? Why is this even meaning? Why is that a big deal? They're saying, yeah, look at our first quarter results. Our first quarter results stunk. The reason why they stunk is because we had pricing here and costs were going like this. Costs were shooting through the roof. And so if we keep our prices here, yeah, of course our margins are going to get squished. We bit the bullet in the first quarter. But consumers, you're going to have to bite the bullet going forward because we're raising prices. We're not going to accept to see our margins get hammered again. That's what Target's saying. Now, they're doing it in a very political way, saying, yes, it was this external conditions leading us to raise prices, which I believe that's the right way. This way you don't have, foolish politicians saying, oh, there's price gouging going on here. We gotta stop Target from raising price. I mean, you see nonsense like that. And so what they're effectively saying is, yeah, pressure on the consumer, you haven't even seen all of it yet. You're going to see a lot more of it as we're raising pricing now. And that's a potential real issue, because that means you're once again going to feed that challenge that Walmart was talking about just in their last call, where consumers are making that choice between food and everything else. And when that's 70%, when the consumer is 70% of your economy and they're starting to struggle with these bills, thinking, oh, food versus everything else starts taking a hit. And everything else is a big part of the economy. And so then you once again start seeing those valuations contract because those sectors aren't growing. those sectors start contracting, apparel, home, appliances, though that creates real challenges. And so this is, sort of a double whammy where they start taking a hit. You see the valuations, take a hit. And then the Federal Reserve, by the way, is saying, hey, we are going to get price stability. So they're just going to keep on slapping higher interest rates. And eventually that's going to result in a weakening of the economy. So that will eventually translate into that recession. But you are in this really murky period where prices are going up, and there's a real possibility you see sort of stagflation, where it's sort of like a weak economy. The underlying businesses are struggling with profits, and so they're taking a hit, but you are seeing continued inflation. And that is the environment that we're looking at here. It's certainly not pretty for a lot of businesses. Now, is this technically a recession? Look, I don't want to get into this is the exact definition of a recession. Yes, GDP fell 1.4%, last year. Is this a recession? How will it play out? How am I personally playing? I'll talk about this element of thinking about a recession, the economic downturn, depression. How am I considering all these aspects? First, a quick plug, where if you're either struggling with this current investment environment, where you're just trying to protect your investments, you're trying to protect your savings, or you want to find potentially exceptional companies to own for the long haul, check out Unrivaled Investing. And in full disclosure, it's the Unrivaled Investing subscribers that keep this channel going. So if you enjoy this content, please make a point of checking out Unrivaled Investing. And if that's not in your budget, I do appreciate hitting that thumbs up and hit that subscribe button. So let's keep going to understand how am I personally doing it. You can also check out this disclaimer on your own time. So look, I have called out some companies that I do own on this channel, one of which is Google. But the reality is, even with Google, a large portion of their sales are tied to advertising. And so if you are facing a recession, yes, they're going to get hit too. And so that's why, everything you own, you want to think about, well, how much capital am I going to allocate to these businesses? And then you start going, well, how much am I willing to allocate to these businesses based on what do they ultimately provide to the economy? Where, when you think about, let's say, Maslow's hierarchy of needs, where does this sort of play out? Does advertising take a hit in a recession? Yeah, absolutely. So for a company like Google, not surprising to see it take somewhat of a hit. And I'm curious to see how that plays out in the quarters ahead with advertising budgets. If effectively consumers saying, hey, I got to spend more on food, does that mean other advertising budgets, sort of start taking a hit? And so that is a question. I am more focused, whether or not it's a recession, whether or not it's an economic contraction, depression, however it plays out, stagflation. My view is no one knows exactly when a recession happens. It's something that you always know after the fact. Oh, the economy was contracting at this point, very definitively. What I think you can tell very clearly is that right now we are in a risk-off environment and is a much tougher investment environment. You have the Federal Reserve pulling liquidity out of the system. And you look at long-term returns for stocks, and generally when the Fed is pulling capital out of the markets, that is a much tougher period, resulting in quite possibly huge declines for shareholders, continued declines. And so I'm very cognizant of these sort of cross currents of what is going on. Yes, pricing is going higher. That will not help the consumer. Effectively, Target saying, yeah, we're going to be raising prices. So I'm looking at this setup and I'm saying I want to own companies that are going to thrive and prosper in this environment. So this might mean, yes, a strong company like Google, where I still think it'll be around for a long time and they're constantly innovating, and I'm very amazed with their new products. And I want to focus on companies with tons of free cash flow, like what Google has. But I also want to say, hey, how cheap could this get in a recession? And so I want to be mindful of that when I consider valuation. I want to, if I strongly believe that this is a risk-off environment, which I do believe it is right now, I want to be compensated for that. I want to say, hey, I want to get paid. If I'm going to be taking risk in a risk-off environment, I want to get paid. I want to be well compensated. And that means you factor in valuation. That means you think about your different growth assumptions. Maybe you lower what you think the growth assumptions could be in the years ahead. And then you say, hey, even with these lower assumptions, am I potentially getting a very attractive return? Playing with those various different pieces. And so that's, looking at all these different things. A lot of companies still aren't free cash flow positive. Once again, I want to get paid. That's what you should be saying to yourself whenever you're buying a stock. Say, I want to get paid. How am I going to get paid on this? So if this is an unprofitable company, how is it going to pay me? Well, what it needs to do is I need to get compensated for that risk that it's not profitable. I need to get compensated with better growth and arguably a better valuation. So think about, okay, where does this company shake out 5-10 years from now? Last few years was not an environment where folks are saying, hey, I want to get paid. Last few years was risk on. Valuations are expanding. We are not in that environment today. So you got to get your head in the right game. This is a very different game than 2 years ago. And I think a lot of folks are waking up to that reality. We are very possibly facing a recession, though no one exactly knows, oh, is this a recession, isn't it? But what you do know is, hey, long term, and this is arguably what makes, an investor like Warren Buffett so great, is that he's always saying, hey, I want to get paid no matter what environment. And so he's looking for the deep value situations. He's looking for the cash cows. He's looking for growth at a reasonable price. And so, for the Unrivaled Investing subscribers, each week I'm trying to call out a range of ideas because I recognize everyone has a different, financial journey. So I do have some deep value ideas. I also have some of those hyper growth things. And the reality is you want to consider all types of bets for different investment environments. Arguably buying those hyper growth companies that are unprofitable, that's great longer term, but you also need to recognize that during those recessions, during those downturns, when investors are like, I want to get paid, those are the ones that are going to get hammered the worst. And so maybe that's like, oh, okay, I want crazy upside potential for these cash burning companies. So that's something to think about. Anywho, if this video has been helpful for you, talking about what's going on with Target, what's going on with Costco, Walmart, the broader recession risk, if that's been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button, and thank you to all the Unrivaled Investing subscribers that keep this channel going. Thanks for watching.